Hello, everyone, and welcome to another Fast Five. My name is Rob Smith, here with Greg Thompson, and today we are joined by Louis Chan, who is a portfolio manager with our portfolio advisory group. Now, Louis specializes on the U.S. side of things, and we've had quite a few questions from clients and people out there on developments of AI. We spoke a little bit with our previous guest, Dom Hardy, on it and thought that it'd be good to bring Louis in to specialize and discuss a little bit further. So, Louis, thanks very much for being with us here today.
Thanks a lot for having me.
All opinions and views expressed by the speakers are not representative of views and opinions of RBC Dominion Securities Inc. All information and opinions provided in this video are in good faith, but without legal responsibility.
So let's hop right into it. The most common pessimistic view out there is that AI is coming, this revolution's coming, and it's going to take over our jobs. And what people have spent their whole lives working towards. Is this view warranted out there? Should employees and business owners just be kind of willing to adapt and see what change comes? What's your insight there?
Yeah, listen, I mean, I hate to start the conversation with a little bit of a downer, but the reality is that with all technological innovation, the proliferation of AI, in my opinion, does pose some risk to some professions, particularly in professional services areas right now, where we're seeing more straightforward retrieval of manipulation of data, more rules-based tasks. Those are areas where we're seeing a little bit more professions being at risk. And in real-time basis, we do see AI displacing some labor in areas such as software coding, in call centers, or even because of the multimodal content generation capability that AI can deliver, we're also seeing some disruption in some parts of the creative functions too. Now, from what I can see so far, though, AI still falls short in some areas, most notably in some areas, in work areas, which are, features areas that have a greater degree of complexity, requires a greater degree of judgment and emotional intelligence. Or heck, I mean, we work at a bank, so within that environment, it's highly regulated, involves a higher degree of fiduciary duty. So I think areas like this will still require a higher degree of, human intervention and human oversight. So I think in those areas, I would use the cliche that people won't necessarily be displaced by AI, but they will be displaced by people using AI, because those people are able to harness the technology to drive greater productivity. So going back to your question, I think it is very important for businesses and also employees to adapt ultimately. The other thing I would say too is that, for all of the potential risk to jobs that AI may pose, as history has shown, technology has typically, ultimately led to the enablement and creation of new categories of jobs. One area that in my mind I'm thinking about right now is that I think that the proliferation of artificial intelligence can spur, greater degrees of entrepreneurialism. Because ultimately I think that AI has the ability to allow people with ideas to ultimately bring those ideas to life and monetize those ideas much more easily. So yes, there is some risk in certain areas that jobs could be lost, but I think there's also on the other side, opportunities for job creation.
Great. Craig, do you have a question?
Again, the biggest question I have, having lived through the original technology revolution where we saw the advent of the internet, like in the late 90s, going into the early part of the century. I lived through the dot-com era, and at that time, investors just focused on anything that was wireless, online, .com, and ignored all the traditional companies. And in my mind back then, and in my mind today, I look at who's really going to be the winner. Well, back then after .com, who really won were the really big traditional companies that used the technology to grow their earnings. Is this something right now where people are so focused on artificial intelligence and other sectors of the market are lagging, that you see upside in some other sectors that maybe aren't getting any love right now?
Yeah, I think there's kind of two ways that I can think about answering your question, Greg. I think that the first way is on an infrastructure level, right? So, a lot of people just focus on just the technology areas and, maybe the model related companies or, say, the semiconductor companies have obviously had a lot of excitement there. But if you look outside of just technology and you think about the infrastructure side of things, the more AI that gets proliferated into the business world, the more that we're going to need some of the hardware that enables AI. So when you look outside of technology, the industrial sector, I think, has a broad range of companies that, ultimately provides the infrastructure around AI. So, if you think about having more AI workloads, it means you need more semiconductors. More semiconductors means you need more data centers to run those semiconductors, which in turn means that you're going to need things like more HVAC to cool all these semiconductors. You're going to need more turbines to generate the electricity needed to power those data centers. You're going to need more electrical systems to help transmit the energy from the turbines to the data centers, etc. So that's one area that, outside of technology, that can be a beneficiary of more artificial intelligence. But if you stick to that kind of power supply chain, that would also take us to areas like utilities, where I think electricity consumption has been the better part of flat for most of the last 20 years. And with the proliferation of AI, that could bring electricity usage up to a more closer to like a mid-single digit kind of range. So that's an upside opportunity for places like utilities. And then, the downstream from that is that, it could also be beneficial for areas like the material sector because, the more data connections that you need, the more power connections that you require, then that's going to be beneficial for things like copper or even nuclear. Right now it's having a little bit of a moment. So that's my comment on the infrastructure side of things, but also kind of more towards your question, Greg, in terms of application. I think we're still in the pretty early days of this, but I do think that companies that are early adopters in utilizing AI can drive differentiated competitive advantage. I mean, if you think back to the retail sector, for example, good 40 years ago, the companies that were able to apply point of sale systems and take that data and use that scanner data to make merchandising and pricing decisions, they were able to drive significant competitive advantages. Think of companies like a Walmart or a 7-Eleven or even a Walgreens back in its heyday. And I think that artificial intelligence has every bit the ability to do that for consumer-facing businesses to help them drive better consumer insights and better customize their marketing to engage with consumers. One other area that I'm personally very excited about is the healthcare space because you're seeing artificial intelligence already being applied to diagnosing diseases. Helping to accelerate new drug discovery, helping to drive better engagement with patients. And that ultimately has great benefits for businesses and also for humanity in general.
Okay, that's a great answer. And, a lot of that we really believe here, like we're big fans of, we see the growth in artificial intelligence. It's not turning back. And we do believe the need for power and putting these data centers together is an important part of it, and it's reflected in the portfolios we run.
So I guess getting back to more AI specific and back to the technology sector, we're seeing a lot of rapid developments from products to services, but I'm just wondering what the probability of the same 7 to 8 companies that are currently leading the AI race and what their outlook looks like over the next 5 to 10 years. Like, will they be around to continue leading the sector? Do you see less saturation in the market and more opportunity for maybe a smaller name today to kind of rise up and join the leaders currently?
Yeah, and I think that it's a very good question there, Rob. And I think that it's probably probably deserves a little bit of a history lesson, because if you think about technological advancements over the past 40 years, we've seen quite a number of significant technological evolutions during that time. We had the PC revolution, and then we had the internet revolution, we had the cloud revolution, and now we're looking at artificial intelligence. And what I would say to your question is that in every single one of those instances where we had that technological disruption and revolution take place, we've seen companies that were leadership in one paradigm, and some of them are able to make that leap. They're able to adapt the business to the new realities, and they remain leadership. But we've also seen companies that might have been leadership in any one particular paradigm, ultimately fail to make the leap. And sometimes they fail to make the leap because of technological considerations. Sometimes companies are not able to make that leap because of cultural considerations, and they ultimately fall off the leaderboard. I mean, think about companies like Kodak. That used to be leadership back in the day, and then they ultimately failed to make that leap from a technological perspective. I mean, a little bit closer to home, Nortel used to be one of the largest market cap companies in the world, and ultimately that fell off the leaderboard also. And as some of these companies fail to make that leap, at the same time, there's also going to be new upstarts that ultimately take advantage of the moment, take advantage of the new technology and all the use cases that it enables. They're able to monetize that, and they ultimately, shoot up to the top of the leaderboard. So, ultimately, to argue that the same, 7 or 8 companies in this paradigm will remain leadership in the next paradigm, you're arguing against a lot of history, first of all. But even from a fundamental perspective, when I look at these companies from a bottom-up basis, I would say that there are companies within that kind of 7 or 8 that has a greater degree of business model vulnerability to that changing technology. On the other side, I think it's still probably a little bit early in the game to really say with any degree of conviction what ultimately rises to take their place. But that's of course something that we're actively monitoring, because there's ultimately going to be great investment opportunities arising from that.
Right. Okay.
It's funny that you mentioned that, because again, I was around for Kodak, and I remember it was such a stalwart in so many people's portfolios. I never owned it, but it was a widely owned stock, and it just got eviscerated.
Absolutely.
And even a company today that's around, and people know Cisco so well, but if you look at a long-term chart, Cisco still isn't back to the level it saw in 2001.
Right. Absolutely. That's a great observation.
Yeah, it is. It's, things change. As far as Nortel, that was more a case of technological theft by maybe one country that we know quite well. So it is interesting. Anyways, go on.
So sure. So is there, hearing all this, is there maybe a lesson in that, despite the generational performance of these magnificent 7 companies that we've seen over the last couple of years, diversification, especially in the technology sector, is still paramount, and gives you the best opportunity for sustained growth over a long period of time?
Yeah, I believe so, Rob. And I think, the way I think about diversification, it kind of cuts 2 ways, right? I mean, on a more, call it, offensive side, I mean, the reality is that, I can do all my fundamental research, and I can, try to come up with my best guess in terms of how the world will evolve and how companies within that will evolve. But realistically, I don't have a crystal ball in terms of how exactly all of these things are going to happen. So what diversification will allow you to get is that it gives you the opportunity to win under a wider range of scenarios. If I think about it the other way, on a more defensive perspective, I think we also have to recognize that technology, as exciting as it is, as it is growth, as much interest as we have in the growth opportunity with technology companies, it's ultimately an area that moves very quickly. And as we saw, even just as shortly as January with the whole DeepSeek incident, we're always just one technological development or one geopolitical event from underperformance in these types of tech stocks. So I think ultimately diversification also allows you to avoid having all of your eggs in one basket. So like I I said, I completely agree with you that diversification remains key for investor portfolios.
Okay. So last question for me here, and a bit of an off the board one. I'm a big Christopher Nolan fan. He's an all-time movie director, and one of his movies is Inception, where Leonardo DiCaprio, does his dreaming within a dream. So I wanted to ask a question in the same, concept, and I asked AI about AI, and asked ChatGPT, what are the most frequently asked questions on AI by investors with respect to equity markets and investing. So one of the top questions that I got was pretty interesting, and I think everyone in the investment landscape has kind of been keyed into to how we answer this one, and really it's how do you value some of these AI companies? Like, is it based on the general revenue and earnings outlooks? Is it new metrics like data advantage and how well your model performs? Is it a combo of both? Can you share some thoughts there?
Yeah, no, I think it's a great question. I'd be curious to learn a little bit more about what other questions that the AI ultimately came up with for you. But maybe I'll tell you what the street convention is for valuing a lot of these AI and emerging tech companies, and I'll tell you a little bit about what I think it should be from my personal perspective. So for a lot of these AI companies and emerging tech companies as a whole, I'd say that most of these companies often start out their life cycle with low or pretty negative earnings power. So, in the absence of having an E and a PE ratio, the street or most practitioners on the street, they just keep going up the P&L, so to speak, until you find a common denominator. So, as a result of that, the price to sales ratio does end up being a pretty common metric for valuing companies in the tech space, and particularly in the emerging technology area. Now, as a fundamental investor, however, I think that from my perspective, everything ultimately comes down to what is the present value of future cash flow that a company earns, right? So, earnings, in my opinion, can be a relatively reasonable proxy for cash flows when you adjust those earnings appropriately. So, adjusting earnings for things like, taking out one-time items, or adjusting earnings for stock-based compensation. So how do we get to these, earnings-based valuations when you're looking at a bunch of negative earnings on a financial statement right now? I think what you have to do is that you have to take a longer-term perspective. You got to take a longer-term perspective and make an assessment as to what are the long-term total addressable market opportunities for the company you're looking at, making a competitive assessment of where these companies will ultimately, evolve within the context of that evolving industry, and make an assessment as to what you think the longer-term economics of that business is going to be, so that you can take all those factors together to make a reasonably informed estimate of what a company's longer-term earnings power is. Now, the challenge for most people is that this is very hard work and it's highly imperfect. But in my experience, having that long-term framework, I think, really allows you to have a differentiated viewpoint, to come up with a differentiated viewpoint versus the street. And that's what's going to allow you to identify upside opportunities, while also at the same time avoiding those companies that may have more questionable business models, and ultimately, preventing yourself from exposing yourself and your clients to significant drawdowns along the way.
Interesting. Okay.
Yeah, the reality is that, artificial intelligence, we're still in such an infancy. When you look at it and you think about how long we've been talking about AI, we've been talking about it forever. Everybody remembers the movie, what is it, Total Recall? Was that the one with Schwarzenegger? What's the one?
Mm-hmm. Yep.
Yeah, Total Recall, and, Skylink or whatever it was then. But nobody really invested.
Oh, wait, you're talking Terminator now.
Terminator, that's it. Sorry, guys. Yeah, Terminator. But, it wasn't until 2023 when all of a sudden ChatGPT came along and said, hey, we've got this, check it out. And then all of a sudden, the Mag 7 were off and away we went. And, things do shift and we're still going to be working to understand the ramifications of AI and how it's going to fit in everywhere. So Louis, we love that, you're working with our portfolio advisory group, able to filter this from all the different analysts and different investment houses that we get research from to give us some good ideas on how to get exposure to this. We really do like your thought about, while there is the direct exposure on things like Meta or Apple or Nvidia, there's also the exposure through the utilities, through other companies like Eaton Corp that are putting together the electrification of the data centers. So, I think those are wise words. Any last thoughts on AI and just, where you see things going, anything that we could be surprised by?
I think the surprise at this point is probably on the upside. And I'd go back to, another cliche where, I think the street sometimes tends to overestimate things in the short term, but underestimate these technological transitions and opportunities on a longer term basis. And, for us here, we try to take a longer term view of our investments. So, that's what we're really trying to keep our eye on. And the more work that we're doing on AI right now, the more opportunities that we see, and the more opportunities we see, both for companies that apply AI to drive productivity in their businesses, but also for a lot of these kind of call it picks and shovels companies that provide the tools and the infrastructure for those AI workflows. So definitely an very interesting area, evolving very quickly, but we think that it can definitely be a source of value creation for client portfolios.
Yeah, no. Again, I always remember the one area that sticks out to me during the dot-com era was the grocers. I just kept looking at like Loblaws and these other people, like you said, Walmart, where you'd see some company come along like pet.com or truck.com, right? And all of a sudden they'd go skyrocketing because they had a .com to their name. But it was still just a small cap company trying to make its way. And I kept thinking to myself, well, isn't Loblaws going to be able to use the internet? And it was so cheap, and we added it, and we looked like idiots for a while. But in the long run, when you have that long-term personality or long-term outlook, you can just make, you can take advantage of other people overlooking what to me seemed to be the obvious. And with a big blue chip company that's going to pay a dividend and raise their dividend, which we always find so important. So again, thank you for your time for this. What I love about this Fast Five that we're doing today is this Fast Five was an idea that was brought by a client of ours. And we want other clients and other people watching that if you have an idea, we want to know what you guys want to know about. And so please don't hesitate to give us some ideas, because the great thing about being RBC Dominion Securities and affiliated with the Royal Bank is that the depth and breadth of analysts and strategists that we have behind us allows us to bring these types of conversations forward. So, Louis, thank you for your time again. Rob, thank you for setting this up. Excellent. And to our client that asked about this, thank you for the suggestion. I hope this fits your needs. And with that, we'll say goodbye, and we hope everybody else enjoys their day. Take care.